Greetings, members, one and all of the Salivation Nation. On the cusp of stagflation, gold and silver prepare. Indeed. Well, some numbers came out today that were not good. In fact, they're shocking, according to a Harvard economist. The economy is shrinking at the start of 2020. This is from former International Monetary Fund chief economist Ken Rogoff, says that odds of a recession are 50% over the next year. Of course, there's no really talk about a recession here, or there's no talk about stagflation here, but that is what is certainly a concern. And in this article here, so The Economist made a comment shortly after it was revealed that gross domestic product, the broadest measure of goods and services produced across the economy, fell at 1.4% annualized rate in the 3-month period from January through March, noting that the number of even below the worst he thought it might have been. The Commerce Department revealed its first reading of the data on Thursday that the U.S. economy cooled markedly in the first 3 months of the year as snarled supply chains, record high inflation, and labor shortages weighed on growth and slowed the pandemic recovery. And Rogoff noted that he was expecting a low number, but the U.S. economy shrinking by 1.4% is shocking. He pointed out that negative growth coupled with inflation accelerating to a new 4-decade high last month is not good for the macroeconomic picture. Can you say stagflation? More on that here in a moment. The Labor Department said earlier this month that the Consumer Price Index, which measures a bevy of goods including gasoline, healthcare, groceries, and rents, rose 8.5% in March from a year ago, the fastest pace since December 1981, when inflation hit 8.9%. Prices jumped 1.2% in the 1 month period from February, the largest month-to-month jump since 2005. So think about that, folks. I'm holding in my hand a crisp $1 bill. You probably have seen it in videos or heard it in videos. And that dollar is losing 1 cent, 1.2 cents over the course of 1 month. Let that sink in, folks. That is scary. So when you combine that, and these are the official numbers, by other measures, and especially if you include the Producer Price Index, we're headed for higher numbers soon. Even Janet Yellen, our esteemed Treasury Secretary, I put esteemed in quotes, is saying that we're going to have this for the next 11 months, almost a year of high inflation. That's going to be happening in spite of her understanding what the Fed is going to be doing. She should know, she was the Fed chair herself, with higher interest rate hikes coming. In fact, the next one coming in May, very soon, in a matter of weeks, will more likely be a 0.5 percentage point. The Fed has to straddle the line here. They've got to straddle the line because when they raise these rates, that takes away the attractiveness of borrowing money. If you don't borrow money, that's not going to inject cash into the economy for goods and services or growing businesses, and that's going to stifle economic growth, which is already shockingly down by 1.4%. High inflation, double-digit high inflation, which is likely what we have now, because when they measured it in the 80s, they used different means to do so. There's a website, Shadow Stats, that says it's up over double digits now. Likely that's where we are at now, which means it's probably higher than what it was in December 1981. So that coupled with slowing economy equals stagflation. Stagflation means that gold and silver should prepare. In fact, that's exactly what this article is here as we do this market report here today. Gold, silver, and platinum heading to support. We may start seeing the bottom of these metals here in this article from Kitco, as reported by Todd Bubba Horowitz. Wednesday, the pressure remains on gold, silver, and platinum. For now, the precious metals are ugly and appear to be headed to support levels. There may be many reasons to be bullish in metals, but price action trumps all. Price always tells a story no matter what our opinions are. However, no matter what the price is, I do disagree with Mr. Horowitz. Gold and silver are pretty. They're nice to look at. When trading markets, you must understand that information you see today is almost always priced into the markets. In a high-tech world, the flow of information is gathered by the funds and firms long before it's reported. Market expectations show the roadmap. So given the slow economic growth that we're seeing reported today, is that reflected in the price too? I don't know. Maybe so, maybe not. But the bullish case for metals ended about 2 weeks ago, which we can see from the bearish action now. Markets are always right, opinions seldom are. In other words, the result of what the markets say. And those that trade can be nimble, taking their losses when wrong, will survive. Those that continue to fight the action will lose and wonder why they lost. Until something changes, gold, silver, and platinum are in bearish patterns and headed to major support levels. The price action supports lower prices. Remember, investors hold and traders trade. And hedgers also hold. Hedgers and savers. And really, probably the best way to look at gold and silver you should consider them as a savings account. Hold for the long term. And that is something, in fact, hold it in such a way that it makes it difficult to liquidate. In fact, gold and silver really are, compared to cash, more difficult to liquidate. And if you enjoy looking at these metals that Mr. Horowitz calls ugly, of course he's talking about the price, not the actual metals themselves, but I digress. Well, you might have some sort of maybe sentimental attraction to the metals. You've stacking them, it's your wealth in your hand. You may like the design of a certain coin, or even a cast bar has a character to it, or a poured silver or poured gold bar that makes it tough to let go. Even certain serial numbers may be attractive to you. Well, it's a bit more difficult. It hurts to sell, as Belange P mentioned in a recent interview that I did with him. It actually pains you to have to sell, and that's just it. There's a difference between wanting to sell and having to sell. If you're frustrated with the price, it's best just to hold on, and you don't really take a loss until you sell. Don't worry about if you don't need to sell. Just don't worry about it, because you know that based off of gold and silver's track record, they will come around for sure. It's a blip in the market when it's all things are said. Precious metals should be owned on a physical basis with capital that is not needed tomorrow or anytime soon. And that's exactly right. Be fiscally responsible when you buy precious metals. Nothing wrong with putting some money into the ETFs, but understand there's counterparty risk there, and it's a representation. It's a position in the metals without actually owning the physical. More than likely, 9 times out of 10, maybe even higher, you won't even want to buy the metal. It's about having a position in it as a hedge against stocks. But when you stack the precious metals, the physical metals, you are saving them. You're really not even hedging, because you do pay a premium on both gold and silver when you buy the physical metals themselves. That is the cost of holding them. And of course, when you hold them, there is a single party risk, that it is of yourself. You are responsible for their safety. So make sure they're stored in a secure location, as well as a cool, dry place as well, too. So trading should be done with paper, knowing that we can trade either sideways without emotions. In all markets, price action determines what will happen in the next day, week, or month. Keep the two strategies separate. The worst trade anyone can make is turning a trade into investment, hoping for a way out. Traders must learn to take their losses and move on to the next trade. Patience, discipline, and money management, fiscal responsibility always wins the day. Let the map of the market show you the way, he says. And I think that's good advice by Mr. Horowitz, indeed. And for sure, it's good to hold on to your precious metals. They certainly have proven themselves over time and time again, and we are seeing kind of a support. I believe that probably given this news about the shrinking of the economy, which is lower than expectations, we are likely to see the metals consolidate here and probably stay where they're at, or maybe move a little higher. especially if we see the next quarter the same type of thing or slight improvement, because these rate hikes that are going to be coming are probably going to squash any kind of growth. And so the Fed probably wasn't expecting this, which means they may only raise it a quarter point now, which means that gold and silver may actually rise when they do that, because they're banking in a half a point rise instead of a quarter point rise in the interest rates. So we'll see what happens there. But nonetheless, one thing about trading, about where the prices are, in fact, as we look at this activity today, we see that gold is actually up almost a half a percentage point, and silver is down over a half a percentage point. And remarkable to see the widening of the ratio between gold and silver now at a solid 81.89, almost to 82 now. We're getting to frustration levels with silver now, but we've talked about that. But I think even silver is going to have some support. I actually took advantage of the lower silver prices in a purchase that I made recently, and I will talk more about that when the order is fulfilled and arrives, which will be about the middle of May. But nonetheless, it's an opportunity. And whenever you make a purchase of precious metals in the physical, especially in the physical, you are at the mercy of the premiums when you buy, and you're at the mercy of the whoever you sell it to as to whether or not they're going to give you any amount above spot. Likely they would, at least to some degree, but what I bought probably would not get any much premium at all above spot if I was to sell it. But who knows? Just depends. There's a lot of demand for silver now. You know, there are people that are certainly is taking root, grounding. They are bunkering down, and they're going to just continue to buy because something's got to give here. And I do agree with that, although I do temper my expectations of silver, especially silver. Gold tends to hold its own. Yes, it is below $1,900, and I thought that was a pretty solid resistance level, but it's not much below that now. So we'll see where it goes, but let me know what your thoughts are in the comment section below. We'd like to extend a multitude of gratitude to you all for taking the time to watch this video. And there is a like button, and if you press it, you will see the number increase for the amount of likes on this video. That's called rating the video. That's why at the very end of the video, when I say please rate, share, comment, and subscribe, I mean to thumb up the video. And I just said it, so I'm not going to say it again. But I will say again to you guys, a multitude of gratitude to you all.